First of all, when you were talking about the moves that we saw last week, to me, it was a lot about positioning and technicals. It was not fundamentals. Let's look at fundamentals. We had a weak payroll report, unemployment rate going to 4.3%. Now, if I were to plot unemployment rate of 4.3% on a 20-year, on a 50-year chart, it actually looks great. It is not consistent with a recession. Recession, we have seen unemployment rate going to 6%, 7%, but not in the 4 handle. So when I think about the Fed, when I think about Powell, and they meet in September and they decide whether to do 25 or 50, I do think they will cut. But from Powell's perspective, yes, we have unemployment creeping up slightly, not consistent with the recession, but at the same time, inflation is still sticky. If from a Powell's perspective, 6 months down the line, they cut by 50 basis points and inflation actually starts going up next year, and unemployment rate still remains below 5%, it will be seen as a policy error. So in my mind, I'm not in the coin toss camp. I'm firmly in the camp that it is a 25 basis points. There is absolutely no need to deliver a 50 at the September meeting.
And I think the conversation around a 50 basis point move really came at the height of last week's market volatility as well, which is perhaps why we saw market pricing shifting so much. It was unexpected that we would see such a significant move, and 25 does appear to be the base case now, at least when you look at where markets are moving and as you have been suggesting. But walk me through how you see yields moving from here. You've suggested at the long end of the curve, the 10-year below 4% looks a little bit on the rich side. I flagged earlier, we're not too far away from that now, but what is the real value? What's the material value in your view?
So to me, 10-year yield between 4 and 4.25 is where I see it. But I think the real juice is at the very front end of the curve. The market was pricing in at the height of the risk aversion around 120 basis points of cuts for this year. Now we are pricing in 100 basis points of cuts. Still too much. My base case is 50, but let's say something does get wrong and the Fed has to deliver in September, November and December, maybe we should price in 75. But 100 to me is just too rich. So that's why when we're looking at the markets, yes, 10-year does look a little bit rich, but to me the biggest juice is really at the front end of the curve.
Okay, so should traders continue to fade this rally in rates?
Absolutely. That is our view. I think the front end, if I want to be too precise, I think the December pricing of Fed funds is what I would fade. But the front end of the curve is where I would fade the current pricing.
Okay, fascinating. So look, traders also looking out for recession signals here. What's going to happen when it comes to the CPI due Wednesday? Are we in for a surprise?
What market really wants is something close to consensus. So liquidity is very thin. We shouldn't forget it's August. A lot of people are on holiday. And what market really wants is close to a consensus number and we can go back to normal. I think a big surprise in either direction is actually bad for the markets. Of course, if you get a much higher than expected CPI number, rates will sell off. If you get a much lower number, then rates will rally. Risky assets will actually suffer in either scenario. What we ideally want is right on consensus.
Okay, and then Jackson Hole also follows the CPI print. So what is the messaging you expect to hear from Powell? I guess it ultimately depends on what type of data we get on PPI and CPI this week.
To me, Jackson Hole is probably the most important event that we should look for the next few weeks. And my expectation is Powell will deliver a sense of calm for the markets. He will indicate that they're getting more confident, that they're ready to cut. They're getting closer to a cut, but there is no need to panic. I think that's exactly the message which I think Powell will like to deliver.